I think we're closer than most people think, maybe a year or two.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. John, thank you so much for joining me today. Super excited to chat with you. All right, John, you are the co-founder and managing partner of Nexyst Digital. Nexyst Digital is a quantitative multi-strategy trading platform focused on liquid digital assets. Previously, you worked at RBC, Oppenheimer, BlackRock, and you're actually a former partner of CoinFund. All right, so John, I've been thinking about how to kick it off with something a little more fun and friendly. Do you have any fun facts to share? Anything interesting around, anything at all?
I do, especially as it applies here to digital assets. And thank you for having me, by the way. And when you did that little kind of recall of my resume, it does make me feel very old. In terms of a fun fact applying to digital assets, now I cannot confirm this, but according to the real estate broker that we use to buy our house here in the Florida Keys, we are the first home purchased, to his knowledge, with Bitcoin in all the Florida Keys. So this was back in 2020. So if we're talking about real use cases, right, real world use cases all the way back in 2020.
That's very cool. But when do you think that we'll be able to get, or the masses will be able to get loans based on their crypto holdings through like a regular bank, not through some kind of crypto native platform? Or do you think that?
I think we're pretty close. I think this new Cantor Fitzgerald's really kind of spearheading this, offering now collateralized loans at the institutional level against Bitcoin. I think that's a big 0 to 1 step. And then I think the next step is probably more retail, which is what you'll see as mortgages and personal loans. You can get personal loans via Bitcoin right now. It's hard to do it at scale. So I think we're closer than most people think, maybe a year or two.
Very cool. All right. So can you tell me about your journey pre-Nexyst? I was going through your LinkedIn and, you have incredible experiences, 15 plus years in TradFi, RBC, Oppenheimer, BlackRock, et cetera, CoinFund as well, of course. Can you tell me all about that journey?
Yes. And I know you're listing my career, but I still do qualify as a millennial. I was born in 1981. So if anyone's turning this off because they think I'm a boomer, I'm not there yet. I started right out of college on Wall Street trading. And I did that for about 15 years as a portfolio manager and a trader, mostly in equity derivatives and equities. In 2015, I got introduced actually at a bar by one of my colleagues to this thing called Bitcoin. I became super interested in it, went down the rabbit hole as a lot of your guests and probably you have done. Started doing some angel investing, got really heavily into kind of the alt scene back in 16 during the ICO craze, and 17, 18. It was a lot of fun. And so I like to say I was physically still in traditional finance until about 19, but mentally I was gone around 16 because I was just searching for a way to figure out how to do this kind of full time in a professional manner.
All right. So tell me about that specific kind of change, because obviously you had a great career in TradFi. You could have kept going, could have kept, crushing it there. Why do you decide to, I guess, quote unquote, jump ship into digital assets? Because I'm sure back then your colleagues were like, dude, sure, but it is pretty crazy.
Yeah. So I made a pitch actually in 2016 to my firm at the time. It was Oppenheimer Funds, that we should consider at least taking a look at trading Bitcoin. Was it a macro? We didn't know what it was. Was it a macro hedge? Was it a monetary debasement hedge? What was it? Right? Was it a sovereign tech form of storage? Of wealth storage. So, I mean, it's a ludicrous thing to think that I even had those discussions. You couldn't custody it anywhere back then. I mean, Coinbase was just kind of coming onto the scene. I think Mt. Gox is where it was the best, most reputable place to put your money. So it was way too early. So I was getting kind of, I don't want to say laughed at, just, John, don't even bring this up. It's a non-starter. That kind of remained the same until about 17. 17, I started to notice a change. A lot of my colleagues and some of the executives would bring their laptop into work, call me into their office and say, "Hey, can you set me up? Like I want to play around. I want to start to get it." And in 18, when our CIO did that, I'm like, okay, this is different, right? Like, I think at the institutional level, there was still a lot of resistance, but at the personal level and at the level of these the financial professional level, people saw it. They understood, at least from an ability to generate alpha, they saw that ability. And that marked a moment for me that I was like, all right, let me see if I can do something professionally with this. And luckily, or I kind of got forced out because our company got bought. And I raised my hand to leave. We got purchased by Invesco. And I said, all right, let me give this a shot. And I reached out. Had been an inkling for a while. I reached out to the Anchorage team out in San Francisco, the custodian, Diogo and Nathan. And I said, hey guys, I have this idea where you could build an asset management arm on the side of a custodian. And their response was, well, we're actually considering hiring our first trader, but we want to talk about this. So I went out there and we had a long conversation about how we could make it work. And this was, at the time, this was really regulatory uncertainty. Where does Bitcoin fit? All right. You haven't had the SEC or anyone kind of bless Bitcoin yet. So we ended up not being able to figure out a way to make it work. So I ended up running just a little fund of my friends and family, digital assets and equities for about another 6 to 8 months before I joined BlackRock. And I was there for about 5 months when I realized that I had gone back in my mind to the dark side, right? Everyone views crypto as the dark side, but I view just going back to what I was doing as the dark side. And I didn't want the previous 5 years to be the next 5 years of my life. And that's what I saw if I had stayed there. And there's nothing against BlackRock. It's a tremendous, tremendous firm. It's just, that's how I saw my life progressing. So I got a call from CoinFund. At the time, I think there was 5 people there. They had managed about $20 million, mostly in seed venture vehicles. And they said, hey, we're building a liquid fund here. We want to build a true kind of institutional asset management firm. Do you want to join? And I said, absolutely. And that was my first real professional kind of leap of faith into the digital asset industry.
Very cool. Okay. So at CoinFund, I just spoke with Jake Bruckman he was the founder of CoinFund yesterday on the podcast. And the AUM now, he said it. So AUM is now around $1 billion, plus or minus. And so it's incredible that you joined back when it was around 20. That's insane.
I always say it was like people talked, when they work in startups, they talk about things being like a rocket ship. And it sounds so cliche. I joined, and I think in about a year and a half post me joining, and I don't think this had anything to do with me. I think our assets grew by $750 million in a year and a half. A lot of it was appreciation. A lot of it was kind of timing was right. We had a lot of institutional people pushing an institutional statement to investors. And then we launched another fund, and it all kind of happened at the same time. So it was tremendous growth. And Jake was there, like spearheading it. It was a really fun time.
Very cool. Okay. So I know that at CoinFund, and this is great. I just spoke with them yesterday, but they do venture, they do, early stage, they do kind of A and B stage, and then they do some liquid trading as well, or, a pretty solid amount of liquid trading. But from what I understand about your strategy, it is very different from what they do. So could you describe to me or kind of tell me how you went from CoinFund into building Nexyst?
Yeah. So, I mean, if you think about money management or liquid money management, liquid asset money management, there was an evolution in the traditional finance side. So you had the early mutual funds and you had the first generation hedge funds. And I'm talking traditional assets. It was mostly long only, right? It was maybe region specific. We do US, we do developed Europe, right? Like if you wanted to add a flavor, you could do that. Then it started spreading across different asset classes. And then think credit, right? Different types of fixed income, commodities. Then you got the quants that came in. And I think over the last, let's call it 6 to 8 years, the large multi-strategy, multi-managers came in and just sucked up all assets and really almost all of the alpha from the space. And they did it in mostly quantitative, and they did it in these packages that give investors a lower volatility product with still a high upside capture. All right. So in crypto, it was early, it was like probably mid 21. I took a step back and looked at, we had this massive growth, right? And alongside us is a lot of the other early upstarts, right? They're all and I know them very well, the multi-coins, the Panteras, right? The polychains. And they were all having this similar growth trajectory. And I was like, wow, they're all kind of doing the same thing. Not that, again, tremendous investors at all these places, but they were long mostly or long only kind of funds liquid funds trying to, if not outperform Bitcoin, stay in line with Bitcoin. And when you're trying to manage against a 60, 70 vol at the time asset, that's really difficult, right? And I was like, so wow, there's going to be a natural progression, just like we saw in traditional finance. We'd actually seen the blueprint of how this evolves, right? Why hadn't this not gone on in the space yet? So there's a lot of reasons for it. And that's when kind of the inkling started of why don't we create it, right? And it was probably late 22, early 23 when I started kind of having these conversations with my partners at CoinFund. And it was just, they're such tremendous long-term investors from the venture side that it's hard to then have them kind of see what I saw, which is let's do super short-term, quantitative, kind of all these different kind of AI pattern recognition strategies in one bucket. And it was not the right place for it. So in 23, late 23, I think they probably got tired of me pushing this kind of desire, right? And it was time that I just tried to do this myself. And that's kind of when I left.
So, okay, you had this vision of where the space is headed. Were you thinking about bringing on or building out a team for this, or were you like, I can do this by myself?
Yeah. So initially I highlighted one person who was willing to do this kind of with me. So when I left in 2023, I started just having conversations with some former mentors and people who I thought were really knowledgeable in the space. Like, am I crazy here? Right? Like, that's the question. I had a great gig. I was doing something that I loved at a great firm, and then I kind of just walked away from it. Meanwhile, to be very clear, it was a mutual walking away. What I wanted to do just was not going to happen. So once I had some validation that I was maybe just a little bit crazy, and then that the idea was really unique, I got introduced to a person who had essentially running their own family office and had been experimenting with prop strategies in digital assets for about 18 months. So they're like, John, you should meet this guy and have a conversation. So we did. And I was like, wow, and his partner Val, who's ex-Citadel, they're doing exactly what I want to do. It's multi-manager, it's multi-strat, it's at the institutional level. They both have real traditional finance backgrounds, very experienced. And they already had 5 quants and they had about $8 million. So, which is a lot more than I had to launch with. So I'm like, I think, and we saw this mutual alignment of, we brought different skill sets to the table. So in January of 24, we decided to partner up, split the business up, and kind of go forward with our idea of Nexyst Digital.
Amazing. Okay, so when I hear multi-manager, multi-strat, I'm thinking, okay, it has to be a fund of funds, right? Like that's what most people would assume. But you made a really cool structure, which is a fund of SMAs, right? Could you talk more about that?
Sure. It's something that was really important to me because it was the ethos of decentralized finance, right? Like, we wanted to keep it crypto native, but at the same time bring tried and true traditional finance, risk management, and alpha capture type strategies to it. So we decided that we were going to allow our traders and our quants to own their own IP. We weren't going to bring it in-house under our umbrella, run it via the Nexyst platform. We were going to create a series of sub-accounts. Think of like a hub and spokes on a wheel, right? So we have our risk management system in the middle, and then outside are these sub-accounts that go individually to each quant. And those quants can only see that particular allocation that we give them and that account. They can't see the master at the aggregate, but we can. We can control the correlation number that our risk that our return profile has. We can control the volatility. So it allows us an immense flexibility with dialing up certain strategy types during different market regimes, and it gives these quants and traders the ownership of their trading strategy. If we decide that we don't want to work with them anymore and we part ways, they own it, they keep it. In traditional finance, it's totally different. That's why you see these massive pay packages when traders and quants go to hop firms, because it's essentially what they're doing is selling their alpha, they're selling their code to and their IP to wherever they go next. And so for us, it was really important to allow the traders to capture that. And so under that kind of structure, we were able to scale really quickly. We had a lot of interest from quants and new quants entering the space and new traders. And we looked at about over that from January of 22 till we launched in September of 24, we looked at over 300 different traders and quant strategies. We incubated about 60 of them. And now we're currently running about 25 orthogonal different strategies between our two funds. So we've done a ton of due diligence on the different strategies that work in crypto. And we believe that the flexibility of our structure allows us to move hopefully faster than our competition.
Okay, so I want to go back to the point you made around these traders that, I just read recently. It was like someone from, I think, Balyasny, I think I'm saying that wrong, but like maybe it's Millennium, I forget, but there's $100 million package to switch firms. And so these folks, they're bringing their strategies with them and the IP. But what about non-competes where they say, hey, if you build, your IP at our firm, you can't sell that. So how is that being?
Yeah, I mean, it's a great question. A lot of the times that non-compete has taken it's already gone through its extended time period, whatever the contract stipulates. A lot of the time it's not transferable. Andrew, when it's not transferable, it's very rare. It's more at the lower level, but at those high level PMs, they're able to leave with their alpha.
Okay, so your thought process, just because, if you're like, hey, we're probably gonna play the digital asset ecosystem will probably play out similar to TradFi in some sense. So that being the case, why would you not want to take the approach of a Citadel, Millennium, et cetera, and copy that model? This model is different. And tell me that what was that thought process?
Yeah, it's a great question. And a lot of it was conversations with traders and our quants. They didn't want that model. They had left that model. They're like, there's the amount of flexibility that digital trading and digital assets offers means we don't want that model anymore. We don't want to sit, again, this isn't everyone, but we don't want to sit in an office with all these other quants and have people who we don't want to listen to try to optimize our strategies and have a central risk book that we think is front running our strategies. And we want this kind of ownership and flexibility. And what it ends up looking like, Andrew, is we are licensing technology. We are licensing code. This code just happens to generate signals that trade across different exchanges. And when we enter this licensing agreement with them, it's a revenue split to them. It's a revenue split to us. And then what we're doing is packaging those different ones to get an overall return profile. And what we're able to do on top of it, and I think this is the most important aspect of this, which I yet stated, is that you can pick and choose the volatility of your fund when you're picking and choosing the individual strategy components of the fund. So what do I mean by that? If if you've been around the space for a while and you see that Bitcoin historically has these 30, 40, 50, 60, 70% drawdowns, right? When you're a long only fund, you kind of experience those same drawdowns and sometimes significantly more, right? There was a lot of firms back in 22 that were down 70, 80, 90%. And this kind of cemented it for me. If you're down 70%, Andrew, you need to do a 2.5x to get back to break even. If you're down 80%, that's a 4x. If you're down 90%, that's a 9x. I mean, those are crazy returns that funds need to do to break even. So if you could control that volatility lever, right, by picking low volatility strategies with high upside capture, you get this really kind of traditional or institutional investor friendly return profile. And that's what we're trying to do. That's who we're pitching to. But I'll admit to you that we got a lot of the first 6 months out of the gate when we launched in September 24 was tremendous. We launched with about $9 million. And we were able to 4x our AUM in just 6 months via new subscriptions. And the majority of it was in our Bitcoin share class, which I will talk to you about. But what we've learned is that we might be still a little early in the space, and that if you're an investor and you've underwritten crypto, and you're like, okay, I've underwritten the volatility of a potential investment. And then you see us with steady compounding returns. If we target 30% return in our directional fund, you might not be interested in that because you're like, oh, I understand that you might not lose more than 5 or 8%, but we're kind of looking for those 200% years, those 300% years. So it was an interesting kind of juxtaposition that we found. They loved the fact that our product was low volatility, but they didn't like the fact that we didn't immediately have that far right spectrum of a potential 3.
They want it all. They want it all.
Yeah. And what we were able to capitalize on was we created a Bitcoin share class. So what that really means is that there was a huge institutional adoption, as we all know, of Bitcoin, just Bitcoin in itself. And people had underwritten that volatility of it and what that would look like. But they also realized that once you own Bitcoin, there's really not much you can do with it, right? It sits on your exchange, it sits in your cold storage, it sits on, if you have a hard wallet, and there wasn't a native yield to it. You had to take some kind of pretty aggressive counterparty risk to get a type of yield. And a lot of the times that was opaque. You didn't know who the actual borrower was of your Bitcoin. So what we did is we allowed investors to invest their Bitcoin in our fund in a Bitcoin share class that P&L is actually generated in more Bitcoin. And I think there was one, I actually just recently posted this on LinkedIn. So if Bitcoin stays flat for a series of 3 years, and our fund returns, again, this is all hypothetical, 20% over those 3 years, you actually have 3/4 of more Bitcoin at the end of that 3-year period. And for being able to capture a finite asset like that, I think that kind of message and that it really resonated. So we've seen about 65% of our assets flow into our Bitcoin share class.
That's amazing. Okay, so I love the structure. I think it's very unique, and I don't know other people that are doing it. Maybe there's some other folks out there, but it's almost like, this is a bad analogy, but it's like the Airbnb or Uber of asset management, because you're controlling the most important things, which is risk management, while kind of offloading a lot of the kind of the nitty gritty, if you will. What are the downsides of this structure? Because I can see clear upsides, but if you had to pick and choose some negatives, what would those be?
Yeah, it's a great question. I think I would say it's competition for quants and traders. I think when we decided to launch Nexyst, we had one other competitor, and this was going back in January of 24. We now have 5. So they understand, again, everyone sees where traditional finance went. So now they're seeing kind of where the digital assets is going to go and the sophistication of the strategies that are now coming to market. So I think probably competition for these new quants is going to increase rapidly. And for us, I think a common knowledge for anybody in trading is that alpha decays, right? And so if regardless, whatever your type of alpha is it statistical arbitrage, volatility arbitrage, momentum reversion? If you have a strategy, generally other people will start to understand that strategy, copy it, and then it goes away. Look at funding arbitrage. 5 years ago, you could generate 40% unlevered returns, right? At a market neutral, just buying spots, selling the future. I mean, unbelievable, right? Now that number is more like 4%. So if you want to generate 40, you got to lever your book 10x. Now you're introducing all this different type of risk, right? So for us, it's the flexibility of us being able to move away from strategies also kind of is combated by this competition for this next new shiny ball of strategies, right? So I think that's a big risk to us in the space, but and I think overall capacity, Andrew, we have some the inefficiencies in digital assets is what allows people like us to really perform, right? You have, 300 different exchanges, I think. It's some crazy number. I actually looked that up. I swear, it's like a crazy number of exchanges. Then you have options, perpetual futures, and spots. So you have 3 different asset classes. So the fact that you have these numbers of exchanges, these different asset classes, and they're all in the same exchange, allowing you to trade against them, allows for so many inefficiencies and so many different strategy types, which is you can extract alpha in so many different ways, which is just, it's so exciting. But at the same time, once a pattern is recognized by all these quants, it will get kind of traded away. So you just have to be flexible and move. And I think the capacity of the space is really interesting. I think we're all waiting on a regulatory unlock from this new administration. Like, what does that mean? And to be honest with you, Andrew, I don't really know what it means. I got to be honest. I don't really know what that looks like and what it means. We've set up our fund in the BVI. So we had, and all of our traders sit offshore, and we have access to all the offshore exchanges, which is a lot of liquidity. It's about 70% of the global liquidity in the way we structured the firm. So I think we need the overall pie to keep growing from a liquidity standpoint, from money flowing into the space to enhance our capacity of our firm so we can allocate more money to our traders.
So do you expect this, I guess we'll call it like a flexible strategy, flexible setup comparative to like everything in-house compared to like a Citadel or whatnot? Do you expect the space to evolve over the coming 5, 10 plus years to end up looking like that, where we have these like 10 or so multi-managers that are just ultra dominant that own all the IP in-house? Or will models like Nexyst model, will that be the dominant model?
It's a great question. I think what our model allows us to do is scale very fast and get access to a lot of unique strategies. I think the natural kind of progression of this is probably if we start to really grow, we will try to take some of these strategies in-house ourselves. I think that's the natural progression of where this goes. So I don't think you're going to get the 2 extremes. I think you're going to get a hybrid model of some sort that ends up being the dominant model. We're not there yet. But this model allows you to scale so fast, and digital assets allow you to scale so fast, right? Like, just, this is why we're all kind of in the space, because it's new, it's inefficient, right? We have talked about it before, and it's in its infancy. So there's a lot of unique aspects to it.
With these trading teams, these are not necessarily funds. These are teams of quants and whatnot. Are there fees 2 and 20, or is it totally random?
Yeah, generally it's a standard revenue share fee. So it could be anywhere from 20 to 35% of the profit they keep. We keep the rest, and that's for the allocation. And we'll get this question all the time. How do you protect against them leaving? And our answer is pretty simple. So generally, a lot of our traders are in Singapore, Portugal, Cayman Islands, like a very friendly, crypto friendly domains. And they can work from their office or from their homes, running their code, their algorithms, and they are doing it in the location they prefer, right? They're doing it without an oversight of some risk manager, like outside of us, right? Like some human risk manager they might not get along with. They're able to operate the way that usually engineers and quants want to operate, which is in their own kind of atmosphere, right? Making decisions themselves, right? And with a little bit of help from us. So they have a tremendous work environment, and they're getting capital and they're making money. So we have not had one who has wanted to leave yet. And we've been doing this now for 3 years.
And when you say leave, in theory, it's these folks become wealthy enough where they're just trading prop and they're like, hey, I don't want to manage any outside capital. I just prefer prop capital.
Correct. Yeah. They're either managing their own money, they're running their own funds. What we've learned is that running a fund is very difficult. As you probably know, there's a lot of setup fees, there's compliance, there's a lot of kind of business that needs to be done outside of trading. So we haven't seen a large demand for our quants to run their own fund. And that's actually why they're here, right? They don't want that overhead. They prefer just an allocation where they get a cut of the fees.
Okay, so I want to talk about the two funds you guys currently operate, Delta Neutral and Dynamic. So could you talk about both these? And I believe one of them, or maybe both, have that BTC share class.
Yep, both of them do. The Delta Neutral fund, think strategies such as funding arbitrage we discussed earlier, volatility arbitrage, and statistical arbitrage. So pairs trading on the statistical arbitrage, right? Staying market neutral to delta neutral. Same with volatility arb. You're selling options, you're buying perpetual futures, and then funding arb. Everyone knows funding arb. I think what we've seen is as funding arb has started to really kind of the returns have started to dampen and decay, we've moved pretty aggressively over to statistical arbitrage and volatility arbitrage. And what's really exciting is statistical arbitrage for years did not work in digital assets. So if you think back to traditional assets, and let's look at equities, and if you have airline stocks, all right, so there's airline stocks. What are the component of an airline stock? Well, they have to pay gas fee. Well, how much is gasoline, right? And then you have components you have aircraft components, then you have the aircraft itself. So there's all these different publicly traded, there's commodities, there's publicly traded stocks that have how they behave determines theoretically where an airline stock could go. So you have these great relationships, and computer models were just able to kind of trade around that and extract alpha. Those relationships didn't really hold between different tokens in crypto. Really, what you had was high beta and low beta assets, right? Well, if ETH does this, these three, Uniswap will do this, right? And so statistical arbitrage hasn't worked. That's changed. About 3 or 4 months ago, we noticed the P&L on statistical arbitrage funds, strategies, to start to really inflect. I don't know why it's changed, but we're still kind of studying why, but it did change. So that's exciting. So we've started to move over there. We think there's a little bit more alpha capture there. And then our dynamic fund is just comprised of a set of short-term trading strategies: momentum, reversion, pattern recognition, volatility trading, and statistical arbitrage as well. I think what makes this very different is we target a 10% vol for the fund. And the way we achieve that is we try to avoid the volatility of long-term holding by having our trading signals fire anywhere from 60 seconds to about 12 hours. So even though we're a directional fund, in 2024, we were only in the market 25% of the time, which that's how you achieve a lower volatility kind of overall return profile, because you're only in the market when you think there's a 90 to 95% probability you're going to make money, and then you come out.
Very cool. Okay, so Are these trading teams, do they often specialize in, let's say, like stat arb or one specific strategy? And if they're doing a more delta neutral strategy, or are they also able to do some stuff on the dynamic side? Or is it often like these teams are doing one thing and they're really good at that one thing?
Yep. It's I guess the latter. The teams specialize in one strategy. You can do some things to the strategy. You could lever the strategy to make it a little more volatile, theoretically. So if you wanted to put it across both strategies, you could. But generally, our traders run individual strategies in a specific bucket. So if they're a statistical ARB team, they have a statistical ARB strategy. And then it's up to our investment committee, which is myself, Val, and Dimitri, to kind of choose the buckets of where we want to allocate, right? And so do we want 20% exposure to volatility traders? Do we want 30% exposure to momentum? And when we say that we're making those decisions, it's the return profiles and the risk metrics of the portfolio of those strategies are actually making that decision, right? There is no discretion at Nexyst. The discretion is in the performance. So if the performance is stating and the risk profile is stating you should allocate more to statistical arbitrage, we will allocate more to statistical arbitrage.
What do the folks do, the teams that specialize in, let's say, funding ARB, and funding ARB has been, those returns have been compressed over the past couple of years. Do they have to just, become very good at an entirely new strategy, or how does that, do they just, shut down, or what happens?
Yeah, it's a great question. We've seen a few shut down. We've seen a few, mostly it's not shutting down because of losses. To be clear, funding ARB is a great strategy because you're either not making money or you're making money. It's not like you're generating 10, 15% losses. It's just that the spread, right, between the funding rate is no longer there. And you're just getting eaten up by fees. And so they just kind of reduce. We have great working relationships with these traders. I think it's a mutual decision. Like, hey, the strategy is not generating. They see it, we see it, and then we just we reallocate to strategies that are working. And a lot of them, you're seeing them pivot now to different types of strategies. And when they have something that works, we're here for them. We'll take a look again, and we can enter a relationship back with them in a different strategy type.
With the share classes, how popular has the BTC share class been? Because for me, when I hear that, I'm like, yes, sign me up, please. That sounds incredible.
Yeah, it's extremely. So like I said, it's about 65% of our investments post-launch have come through the Bitcoin share class. And just recently, we've created a structure that allows USD investors to get access to the economic benefits of our Bitcoin share class. So we'll do the conversion at our fund administrator ourselves. They are invested in the Bitcoin share class, but when they redeem, they get dollars. So that came out of demand from a lot of clients as well. And it's just it seems that something has changed over the last month, and there's just a massive demand and a run on Bitcoin ownership or exposure to Bitcoin. And it's exciting to see because a lot of the strategies, we spent about a year and a half making sure that our strategies actually are profitable Bitcoin on Bitcoin, because the way it works is a strategy, like your trading pair, it has to be Bitcoin for a lot of these strategies.
Very cool. How are you sourcing these different teams?
Yeah, it's a great question. A lot of them came initially from our partner, Val, his network of quants. Val was a high frequency trader and researcher at Citadel. He ran a large futures book there, as well as his own fund a little bit later. And he had a good network. And then word of mouth came from there. I think we got lucky again with our timing, Andrew, is that we were one of the first to do this. So we had a lot of inbound in the first kind of year and a half, 2 years. The inbound has slowed only because there's more competition now. So we do at times use, there's capital introduction partners for allocators. There are people who can find strategies and quants that will feed them to us as well.
Awesome. Okay. So you find a great team. They're doing a strategy you think is interesting. tell me about your process of now doing the hard work, the diligence and the vetting of these people and strategy.
Yeah, so there's three pillars. We call it qualitative, quantitative, and then a portfolio fit. Qualitative is you have multiple meetings with them, whether it be Zoom, in person, depending on their location. You understand their background, their view on risk. We always say we're a risk first team. So really, that's what we like to understand is kind of their thoughts on risk in the space. Getting to know them, getting to know the strategy, seeing, and then it turns to quantitative, which is looking at the track record, the Sharpe ratio, the volatility, and then actually getting their 8 read-only API keys from their live trading ingested into our risk system. So now we can validate everything that we've seen on paper in-house. And that process, that's probably the lengthiest process. That's 2-3 months developed, depending on the frequency of the trades. The more data we get, the easier it is to kind of determine if we want to move forward with the strategy. And from that point, we get to see, is it correlated to anything else in our book, right? Because that's the key. You want orthogonal or uncorrelated strategies. The highest correlation between any two strategies in our dynamic fund is 22%. So these things are constantly doing different things, even though regardless of what Bitcoin does, right? Like the dynamic strategy only has a 6% correlation to Bitcoin. So like we've created this fund profile based on our ability to look at how these strategies would perform if they were in fact inside the fund already. So by the time we allocate, which could happen now at 2 or 3 months, we know what we're getting. We've seen it perform. We know what it's correlated to. We know what it's going to do to the risk profile. And so now we start allocating. And a first check from us is generally $250,000. And if that works, it can be ramped up extremely quickly to as much as $5-6 million.
That's so cool. Has there been any unexpected findings from, your process of DDing these teams, whether it be something that arises from, getting all their trade data, or just anything that's you're like, oh, wow, I didn't expect that this thing would happen, or this finding would occur?
Yeah, I mean, it's really hard to verify results. And I would say the greatest differentiator for us on the verification of results, Andrew, is asking if we can get their read-only API keys. Because if you're willing to do that, you're saying, yeah, I can stand by my results because it's going to be exactly like our what we set you. If they're not willing to do that, that's like that. We have noticed that's the biggest red flag in our entire process. So that's been the greatest finding by far. It's been incredibly helpful for us. It's been great for our investors. That was by far the most impactful finding.
Have you noticed anything on alpha decay within crypto, where you mentioned the funding arb has gone down, and is the alpha decay, is that ramping up, or is it kind of staying the same, or how is that looking?
I mean, we get a lot of questions about funds in 2021 and 2022. Some, including ourselves, had massive returns, like 200, 300, 400%. And that's you don't see that much anymore in crypto. You see 30s, 40s, and 50s, right? And we get asked why a lot. And we say, well, the easiest factor when it comes to factor investing that makes the most amount of money and is the laziest is momentum. The momentum factor was dominant in 2020, 2021, and 2022, right? 21, it was on the upside, 22 on the downside. It was dominant. That factor has seen the most decay from what we've been measuring, right? So when momentum is not easy, returns generally are more compressed, which is also something that we anticipated. This is another reason why we wanted to create Nexyst Digital that did not just rely on momentum, did not rely on long-only momentum of alts, right? Because I mean, you've seen the alt cycle has just been massively compressed. You get a month or two of insane returns, and then they give them all back in 3 days, right? And that used to be a year, or it used to run 2 years. And that that's momentum. That doesn't really exist, right? So you need to be quantitative. You need to be relatively high frequency, and you need to be able to go long and short quickly, right? Change the dynamic of the fund. And that factor, I think, for us it's allowed us to build a pretty diverse book, right? And being able to measure the decay is extremely, and acknowledge that there is decay, right? Like, I think there's a lot of people that won't acknowledge there's alpha decay. We will acknowledge there's alpha decay. We see it firsthand. So once you acknowledge it, you can diversify your book to kind of attack it.
All right. So has there been a period of some massive drawdown that while you guys have been active, how is your risk management system? How is it like, what is your reaction during that period? Are you just, all hands on deck, or what? Yeah.
I mean, remember, I co-managed a relatively long only book in crypto for a long time. And in crypto's 24/7, right? So and crypto loves announcing news. And now we have an administration that likes having really market moving news on weekends. There's no liquidity. So I remember back in 21, 22, there'd be a volatile move that happened on a Saturday night, right? And you look and the entire portfolio is down 30%. And you're like, okay, well, I need to look at what happened to see if this is a real move. Is it a buying opportunity? Is it a selling opportunity? Why? Did something happen that invalidates one of our theses and we should actually be selling down here at 30%? Or this is the massive buying out. And by the time you could make that decision, markets had already moved, either another 20% lower, 20% higher, right? And it was crazy. And for us, that was another moment that I realized, this has to be done quantitatively and fast. And I don't want to be there for that volatility move. I want to trade that move, but I don't want to be holding and stuck in that move. So I think for us, our first real test was February and March of this year. And when we saw implied volatility spike, right? And you heard some of the largest systematic funds in the world had their first down months in 4 and 5 years in traditional finance. So, and we suffered our first loss too. We were down 2%. And then I started looking at, there's a lot of these, they do, I guess it's called fund management insights, and they show you all the returns of the different fund types. And I think the average fundamental discretionary fund in February was down 30%. And then in March, it was down another 20. And I was like, I was not happy that people generated losses, but I was happy that Nexyst and the way we kind of comprised this fund behaved as we expected, with a very low drawdown.
That's awesome. Very cool. All right. So I want to know what does your infrastructure look like? The actual, kind of, the flows and the mechanisms of all these different SMAs and the assets and the tokens and whatnot. Because what I'm thinking is a lot of these strategies, I would imagine a lot of them have to have a healthy portion of tokens or assets on exchanges. And so how do you factor in that risk? And just tell me about that whole infrastructure base.
It's a great question. And one of the scariest things about running money in crypto has always been exchange risk, right? And opaqueness. And I've been doing this since 2020 or 2019. And I was trying as hard as I could once I got the Nexyst to reduce our exchange risk. And that usually means reducing return potential, right? Because a lot of these exchanges that are illiquid have unbelievable alpha opportunities it goes with the kind of risk with the reward. We made the decision not to kind of face those exchanges very, very early. We only face OKX, Deribit, and Binance. And I think one of the biggest positive infrastructure changes for us was using a custodian called Campagna, based out of Dubai. They're the Japanese investment bank. Nomura is the majority owner of them. And they created a technical integration with OKX that allows our assets to stay in cold storage at the custodian, but we get, call it trade credits in the dollar for dollar at an extremely nominal fee to trade on OKX. And it's a version of off exchange settlement that you might hear. So every 24 hours, there's an automatic settlement taking place based on the P&L generated. If we're positive, if there's funds flow in. If it's negative, funds flow back to the exchange. And for us, it's great because now 80% of our investors' assets aren't exposed to exchanges. It's sitting in cold storage, which we can argue about the security at cold storage, but I don't think anyone would say that it's more risky than an exchange. And my goal is to get to 100%. That's going to require a lot more integrations with exchanges, but I think we can get there in the next year or two, which would be great because then investors will feel a lot more kind of comfortable investing in crypto liquid funds.
That's amazing. Very cool. All right. So how do you think about building out your team at Nexyst? Because I mean, it sounds like, and maybe this is totally incorrect, but it doesn't need that many folks at the firm, or is that incorrect? As you scale, maybe you will need to scale with more talent, or how does that look?
I mean, I think there's two ways to look at this. And I looked at this and so as my partners did, there's two parts about Nexyst. We thought we could build amazing return profiles. We really did. And we think we have in our dynamic and our Delta neutral fund. The second part is we saw a great business opportunity because I mentioned that how our traders are distributed. We did not need a lot of employees. We thought we could do this on a pretty lean team, right? So we could build a business pretty profitably. So right now we have a CFO, and then it's just the three founders, myself, Val, and Dimitri. Our CFO, David, sits out in the UK. And then we have a lot of strategy sessions on what the new hires would look like. I think if we start bringing strategies in-house, Andrew, now you're talking compliance. Now you're talking more risk people, right? Now, but with all this new AI kind of empowerment, right, it enables us to scale the business side almost as easily as the investment side, just because of digital assets' ability to scale businesses. It's truly incredible to see how lean we can run. I think over the next 6 months we'll probably have to start making some decisions, and I don't know what that looks like. Is it more business development help? Is it more investment help? Is it more risk help? I don't know what it looks like, but I do think we can run this leaner than I've run previous businesses.
Very cool. That's awesome. Okay, so you said the magic words. You said AI. We have to talk about AI, of course. All right, so from an operational standpoint, AI makes total sense, makes your life easier and just doing day-to-day tasks, very, of course, 10x easier. But in terms of investing, how do you expect that to evolve over time? Because there's some folks that sit in the camp of, oh, there'll likely be no human traders or investors in 10 years from now because AI will take over, or that's completely incorrect. What are your thoughts?
Yeah, it's something that we talk about a lot. A lot of arguments, not like arguments, healthy discussions in our debates in our investment committee. I will tell you, here's where I stand. I think from a risk management standpoint, there is a lot that AI can do and help with, right? And it just highlight pockets of risk that you might not have seen, right? And really isolate tails, highlight areas, and move faster with, you're getting overexposed to this factor, or this is happening. Correlations are creeping in your volatility arbitrage. Last time this happened, based off pattern recognition, you saw these returns. You should consider reallocating away. Like, we're experimenting with that stuff now, and it's fascinating, Andrew. But again, it's risk. It's more risk focused. It's protection versus them generating signal. And Val has 2 PhDs in neuroscience from Caltech and physics, and then a machine learning doctorate from MIT. And he is the AI guy, right? I mean, he was doing this 15 years ago before anyone talked about AI. And he is not convinced that AI can generate alpha. He is totally on board that it can help from a risk management standpoint, but he has not seen it able to consistently generate alpha because it's totally different things. It's predictive versus using kind of things to help tell you what has happened in the past could generate this, but it's not necessarily alpha enhancing, if that makes sense.
That's crazy. Yeah, no, it's the arguments that a lot of folks have with AI today are kind of not the argument, just kind of the pushback. They say that AI cannot develop novel insights. They're really, really good at everything that has existed. And as you mentioned, the risk management and everything that, aggregating all that data and producing information. But in terms of creating novel insights, or in this case, alpha, that's super interesting. I wonder, the idea is that eventually changes and AI will be able to develop novel insights. So I guess once that happens, we're going to have to get Val on the podcast and he's going to have to tell us all about it.
What I think is what you're going to see, Andrew, is that I think what gets bifurcated is the investment styles is going to be hollowed out in the middle as a result of this, where there's going to be extreme, I don't want to say lazy is the wrong word, low frequency, let's call it that, longer term, almost like liquid venture, right? And then sophisticated higher frequency, right? Because in the middle is the danger zone. I especially in digital assets, right? Because if you're super long-term focused, you have a concentrated portfolio and you know the technology in and out, every dip is a buying opportunity, right? If you're somewhere in the middle, I think where you're trying to generate good monthly returns, but you're not really short-term, but you're not really long-term, I think that is incredibly hard, especially in digital assets. And I think that starts to go away because a lot of, like I said, this risk management tools that allow you to make faster decisions.
And so I would assume that you would lean more on the speedier side versus of course. Very, very cool. Okay. So give me the 10-year grand vision. You're back in the pod 10 years from now. Where is Nexyst?
Oh, great question. All right. So where's Nexyst? I think we are, like I said, I think we're a hybrid. I think we're running some Nexyst internal strategies. I think our client base, I think, is probably what looks the most different to you, Andrew. Right now, we're high net worth, we're family offices. We're talking to some protocols to help manage their treasuries. I think because of how we can target volatility and target potential returns, I expect our institutional investor base to grow. I can see us helping out insurance companies. I can see us helping out endowments. I see us becoming, hopefully, a digital asset version of a Citadel or a Millennial, where people they see consistent compounding 15, 25, that maybe every year, and every once in a while we have a big year, right? Returns with comfortable knowing that a down year is going to look something like 2.5% to 7.5%, right? And I believe that will allow us to achieve scale and kind of achieve the institutional investors that really we launched this for. So I think that's how we look different in 10 years.
That's incredible. Okay, so that's amazing. I love it, but I wanna propose this idea, or just kind of this little thought. Wouldn't Citadel? Okay, so of course Citadel wants to enter the ecosystem. I think they've already been doing some stuff on Citadel securities with market making, but wouldn't you imagine that they would come in and they would just acquire, or just like you guys, and just ton of the other top firms and just put them all in house? Or it's almost like AI today. Everyone's like, oh, AI, the people who are benefiting the most is Google and Microsoft, et cetera. Won't Citadel, Millennium, et cetera, just become the dominant guys here?
It's great. It's a great question. It's funny when I get asked a lot, John, what do you see the biggest risk to your business? Right? Is it a stable coin DPEG, which is a big risk? Is it an exchange bankruptcy? I go, what? And I'm like, honestly, it's the floodgates opening for a Citadel or a Millennium. You said Balyasny, all of a sudden getting the go ahead, regulatory wise, to start putting pods in all these different countries to exchange these different access these different exchanges, right? But the way this works right now, Andrew, is that they can't. There's regulatory blockers that just don't allow an entire team of thousands of employees with U.S. domiciled employees trading through servers onto Binance. Doesn't work, right? And if you do separate the teams and put them over, well, they have to be separate entities. And it just creates a corporate, like it's a real headache. They haven't been able to figure out a way to do it yet. We think it's eventually going to be done. We think we have like a 3 to 4 year head start, and we're hoping that we can achieve enough scale at that point. So you're right. They either buy us rather than coming in tomorrow and actually buying our traders. That's the fear. The fear is they come in, they know, they somehow find out that a particular stat arb guy is tremendous, and they offer them a $40 million exclusive package, right? And that's that, because we can't offer that. And I think that's my fear, but they're not there. I think I just saw that, to your point, the Citadel, I think Millennium might have announced that they might be trading spot for the first time. I mean, if they're talking about trading spot for the first time, that's very different than creating pods, right? Arbing different exchanges throughout a different region. So I think we got a runway.
Amazing. John, this has been incredible. It is time for the closing questions.
Here we go.
All right. What trend is totally overhyped and what trend is totally underhyped?
I think the death of Ethereum is overhyped. If you've been anyone who's been in this space, we focus way too much on price appreciation of tokens, in my opinion. And from a technological standpoint, everything is being built on Ethereum that I think has real world implications, right? In my mind, it is the only blockchain where real world applications are going to be built and are being built. I think it has that ability to truly cross over into kind of mass adoption. And I think all this calling for the death of it just makes no sense to me. When you understand how, if you talk to people building in the space, 95% of the teams building are building on Ethereum or on Ethereum and something else. They're not just building on Solana or whatever it is, right? So for me, I think that's overhyped, I guess, or over talked about. Underhyped. I still don't think people grasp the infrastructure or the funnel that's been built for Bitcoin only. And there's a lot, I think you've seen, I mentioned earlier on the pod that you've seen these shorter cycles of alt performance cycles. And the reason is there's a declining pool of money that is just sitting in retail exchanges or in DeFi, because the money is actually going to these traditional ETFs, right? Like different structures to access Bitcoin. It's almost like, and I had a friend mention this, and I loved his analogy. He said, imagine if the high yield bond market came out in 1988 and was like, hey, we have this new high yield bond structure. It's really cool. We're going to allow it to be publicly traded, but only AT&T is going to be able to issue the high yield bond. Nobody else. So if anybody wants to buy a high yield bond, they have to buy AT&T's bond. So obviously that thing would get all the flows, right? And I mean, it's a very simplistic kind of analogy, but that's what traditional finance has done. They've truly built a funnel for Bitcoin. And I think and then as Canner enters a space, right, with collateralized loans, and you have MicroStrategy. Now, what is it? The Canner Equity Partners, I think that's a mini MicroStrategy, strategy now. And you have this constant purchases of Bitcoin. I don't think you've seen the highs of Bitcoin dominance. I still think this is a Bitcoin market. I'm not calling for 500,000 Bitcoin in the next year or two, but I'm calling for outperformance of Bitcoin and Bitcoin related kind of products for the foreseeable future until there's an equal playing field of how dollars get to these other assets.
Very interesting. Okay. So in the other assets, I mean, primarily it's
ETH, Solana, right? Any other alt, right? I think I think there's some obscene number. I think there's 3 million tokens or something like that.
Every day on Pump Fund and whatnot.
Yeah,
There's,
right.
So,
But investable tokens, probably, I don't know, 500 maybe. So I do, it's recycled capital that inside the crypto ecosystem that's going there, right? So I'm not saying you're not going to have random bouts of alt explosion. I think you will, right? It's just, I don't know how they're sustained until you create a infrastructure that allows for consistent flow of money.
So are these traditional products, are they bearish for altcoins? Because if I have a Dogecoin ETF and actual Dogecoin, I would just, most investors would prefer the ETF because it's safer and easier. Okay. So it's not bearish for alts.
It's bearish for alts, right? It's bullish for anything that gets a traditional version of it, right? But it's like, so I think ETH products, I'd like to see them pick up. I'm a little confused on why it's had constant outflows in the ETH ETFs, other than maybe it's because it lacks the yield component. I'm not sure that's going to be a massive unlock, but it might be, because you can't say that that's the reason when Bitcoin doesn't have a yield and is get consistent inflows, right? So I do think it's net bearish for alts, and I think you've seen that. I don't think this is a crazy statement. Bitcoin dominance has just been up in the right for the last year and a half, right? And that's got to be because of these traditional products that are just constant buyers. There's a constant bid from TradFi on Bitcoin solely.
Oh, okay. That was great. All right. Looking back at your time within the crypto ecosystem, what's the biggest thing that you've changed your mind about?
Oh, wow. The biggest thing I've changed my mind about. So it was back in 2016, and I think it was 2016 or 2017. It was one of my first angel investments, and it was this company. I thought that the end goal of crypto was going to be to link all these exchanges. All this fragmentation was going to be solved. And this company at the time was named Coin, Quoine. Then it rebranded to Liquid, and it had this thing called the World Book, Andrew. And it was based out in Japan, and it was going to link every single exchange. So if you signed up with this thing, you were going to be able to access every exchange through this one thing. I loved it. I thought it was like the end goal, because fragmentation is at the time, I thought fragmentation was wrong, right? I didn't like it. It was too much inefficiency. And I wanted this access to these deep pools of liquidity. And I've changed my tone completely, because I think fragmentation or inefficiency is what creates opportunity, right? And so for me, I don't know I think there's going to be regional differences. There's going to be regional exchanges. There's going to be dominance in certain exchanges. I think there's going to be certain asset types, perps versus I think this inefficiency, or this fragmentation, if you will, is really good, when I used to think it was actually really bad. So I think for me, the opportunity set that fragmentation offers now outweighs this pursuit of one single liquidity pool, global liquidity pool.
Love that. All right. How do you expect investing to change over the next 10 years?
Investing in digital assets?
Investing just fully, TradFi, digital, everything.
I would love to say that crypto eats, or digital asset eats TradFi. I don't think that's correct. I like to say we ply our trade in the asset class of digital assets. We're not saying it's superior to other assets. It's just we've been able to find more inefficiencies. So I think what you're going to see is us, digital assets, being on the shelf of options for people from equities, bonds, commodities, things. I don't think there's going to be that much different in terms of way people invest. I think the opportunities, if tokenization can really take off, and people can access stuff like real estate in a crowdsourced format or a tokenized format, or like antique car fractional ownership, all that stuff, I think you'll see a little bit more opportunities maybe there from tokenization. I would love to say that there's going to be more peer-to-peer lending and banks are going to be pushed to the side. I just don't know if that's really going to happen. I think it's the percentage is going to be larger, but I don't know if it's ever going to be equal in 10 years. It'd be equal to kind of what we're seeing. So I'm going to take the boring route of saying, I think you're going to see marginal growth on crypto attacking those areas. I think we'll be on the shelf for other equity funds and stuff like that. But I don't see a major difference in the overall kind of like percentages of where, and if a dollar goes 80% into equities, I don't think that's suddenly 30 cents and 70 is going to crypto.
What about the tokenization of assets, meaning like real estate or loans or whatever, all these different assets? And in that world, I think it would be really fruitful for you guys because there's all these new assets, that are trading that are readily available for you guys to jump in on. So
yeah, I think it'd be really cool. I mean, I want to see it. I want to see it take off. I want to be clear. I mean, I've seen so many different variations, Andrew, since we've been investing in this since like 2016, 2017. None have really taken off. I hope they do. I love the idea of tokenization. I think in a weird way, I think you'll actually probably see it applied to equities somehow first, rather than in like this like aha mass adoption moment. It might happen to equities, which is kind of weird if you think about it. But I would be great. I think it'd be an opportunity for us. Absolutely.
What's been the biggest blocker in your opinion? Like regulatory, or what do you think?
I think it's regulatory, and I think it's just behavioral change. If it's tough. Like there's a learning curve. That learning curve requires it's hard work, right? Like I say I've been doing this for 7 years, and I learned something brand new. There's a new piece of technology in digital assets almost every day, and so it really takes a lot of effort to stay up on it, and which means that from a regulatory, if you're a traditional firm, you're always kind of behind, right? Because the space is moving so fast. So I think that's why it's almost like there's a wait and see, like, all right, we're going to see which tokenization version, what platform works, and it starts to be kind of adopted and gets real first mover status. And then I think you'll see the movement.
Makes sense. All right. Last question. Is there a piece of content, whether it be a book, podcast series, a movie, whatever, that had a major impact on your life?
You mean other than angels to allocators?
Well, thank you. That a great plug, by the way.
I mean, I think in the early days of crypto, when I first started, I was really into Raoul Pal. I loved it. He was the first mover. He was great. I really like this. The early stuff that he talks about, a friend and I were just talking about this, is still completely applicable, right? Like he was talking about where he thought Bitcoin was going, where he thought Ethereum was going, why, right? Like the power of network effects, right? And when you think about that, that is all still existing today. And the simplicity of M2, right? And the money supply and what happens to Bitcoin. Like we didn't need all these other people to make like, oh, what is Bitcoin? Is it if you follow back and just look at the early days in 2016, 2017, the stuff that he talked about, it's all applicable. And that's really all you need to know to make investing decisions. It's pretty cool.
That's awesome. John, this has been incredible. Where can people learn more about yourself and learn more about Nexyst?
Yeah. So if you go to www.nexyst.net, that talks about our funds and kind of what we're offering. I have you can also access our YouTube channel from there. Feel free to go to my LinkedIn profile, John Campagna. I have a lot of content there. We have our webinars that we've hosted. So yeah, if I didn't bore you enough on this one, you can get bored on those additional ones.
Amazing. Thank you, John.
Thank you, Andrew. I appreciate it.